Hello, welcome to Accounting with Mr. H. In this video, we're going to look at how to prepare a schedule of non-current assets. Please do subscribe to the channel, thank you if you already have, and like, share and comment on the videos. Let me know what you find useful and what you'd like to see in future videos. Let's get straight to it then. Here's the question we're going to look at. In this video, the following information is provided for Bell Limited at the 31st of March 2023. And I can see in the table there that they have grouped their non-current assets into three types: land and buildings, plant and machinery, and motor vehicles. And I've been provided with the cost, the accumulated depreciation, and the net book value of each of these types of non-current asset. The additional information, if I just skim read to get a feel for the question. So item number 1, land and buildings were revalued. Item 2, plant and machinery was purchased. Item 3, a motor vehicle was sold. So during the year, three things have essentially happened: a revaluation, a purchase, also known as an addition or an acquisition, and a disposal. The bullet points tell me about their depreciation policy. All depreciation is charged on a month-by-month basis, and I can see there whether we use straight line or reducing balance for each of the types of non-current asset. And I'm being asked to prepare the schedule of non-current assets for the year ended 31st of March 2024. You'll see I've already laid mine out ready. I've got my title. So who, it's for Bell Limited. What is it? It's a schedule of non-current assets. And when for the year ended 31st of March 2024. And I've drawn up a column for each of the types of non-current asset that this company has. And that's essentially how you would lay out any schedule of non-current assets, look at the information provided and draw a column for each type of non-current asset. Sometimes there's something called a total column, which will be added on the end, literally just totaling up the figures in each of the rows. But often in exam questions, they don't ask for a total column. Right then, let's get started on the answer. So when we're doing a schedule of non-current assets, the best way to think of it is in three sections. And the first thing we're going to consider is the cost. So I'm going to put my first side heading, then there we go, cost. And what the point of the schedule of non-current assets is to explain to any user groups, for example, shareholders that might be looking at the accounts, how the non-current assets have changed from the start of the year to the end of the year. The statement of financial position shows me some information about non-current assets, but all a statement of financial position shows is the figures at that point in time at the end of the year. And if I was, for instance, a shareholder, I might be looking at the statement of financial position from the end of one year and then the end of the next year, but I don't know how we've got from the figures in the one year to the figures in the next year. And the schedule of non-current assets, this is the document that explains to me how and why those figures have changed. So looking first at cost. So remember, this is the values that that were spent on actually buying the assets in the first place. So I'm going to start with what the costs were at the start of the year. Now the table on the top left, that was the information at the 31st of March 2023. So that was the last day of their last financial year. So that must become the correct data then for the first day of this financial year, which is the 1st of April 23. And you'll see I've put my narrative and I've just entered in the cost figures. 240 for London buildings, 80 and then 55. And then what I'm going to think then, I'm going to work through different stages here. And the first thing I'm going to consider is, if I look at the additional information, item 1, land and buildings were revalued to £420,000. So when they first purchased them, they had a cost of 240. That's how much they cost them to buy. They've had them professionally revalued and the value has increased to 420,000. So all I'm going to do then is record the increase, there we go, of £180,000. Next thing, the plant and machinery. It tells me in item 2, plant and machinery was purchased for 22,000. So that's as simple then as recording that as a purchase, an addition. I'm going to call it an addition. Just make sure obviously you're getting things in the right column. So this is plant and machinery. So in that plant and machinery column, that is increasing by 22,000. And then finally, I'm looking at item 3, which was the disposal. A motor vehicle was sold on the 31st of December for £4,800. It was originally purchased on the 1st of October 21 for £15,000. Remember, the section I'm doing at the moment is just looking at the cost. So I don't want to know what it was sold for. What I want to know is what was the original cost. And it tells me that was the £15,000 figure. So I'm going to have then disposals, and I'm taking out of that motor vehicle column £15,000. So of that £55,000 that we started the year with of motor vehicles, we have disposed of, or the company's disposed of, £15,000 worth of those motor vehicles. And then to finish off this section, I simply total up each column. And so I've got the date then at the end of this financial year, the 31st of March 24. The land and buildings should now be the new revalued figure, which it is, 420,000. The plant and machinery is increased because of the purchase, and the motor vehicles has decreased because of the disposal. And there's the first section done, the cost section. Remember, the cost section is literally just that. No depreciation going in here. All we are doing, and all those figures are cost figures. All right, then let's move on to the next section. So the next section is then the depreciation section. And there's my heading ready to go. And this is the section where there's often quite a lot of workings to be done. And in exam questions, this is where you can often pick up quite a few marks. So it's important you show very clear workings in this section. So I'm going to start similar to the cost. I'm going to start with the dates. What was the date? The 1st of April, and what the balances were at the beginning of the year. So they've just been copied from the table. Then I'm going to think about things that will have changed the depreciation during the year. And the first thing to consider is the revaluation. When you have a non-current asset revalued, the best way to think of it is like starting again with the figure, the depreciation. So originally it cost them 240,000, this land and buildings, but because they've now had it revalued and it's been revalued at 420,000, that is now the figure today of what the cost or the value of those land and buildings are. I can see that this company has already done £72,000 of depreciation historically on land and buildings. If I leave that in the accounts, immediately that's going to reduce the 420,000. But that can't be right because they've just been revalued to 420,000. So I don't want to take 72 off. We've just been advised that they currently have a value of 420. So what we need to do with the revaluation is to eliminate, which basically means remove, the depreciation, the historic depreciation on that asset. So you can see there then I've put a heading eliminated on revaluation, and I'm going to work out that figure in a second. Other things to consider, if they've disposed of a non-current asset, which they have, then any depreciation that was done on that asset also needs to be removed or eliminated. And there's that narrative ready. And then the final thing I'll need to consider in this section is what is the charge for the year? How much depreciation have we got to do on each of these types of non-current asset? So I've got my headings in ready to go, and I'm now going to work through the figures. Those headings, that's as bad as it can get in this question. Those three things: eliminated on revaluation, eliminated on disposal, and charge for the year. So if I go back to the land and buildings, then we've just explained that we are starting again. So literally the 72,000 that's been done historically, I just want to get rid of it. And there we go, I'm just going to take it straight out the accounts. Now I need to start working out the charge for the year on land and buildings. So let me get a working box, there we go. So if I read then over on the left hand side, it says all depreciation is charged on a month-by-month basis. The land and buildings are depreciated using the straight line method over 40 years. So the first thing I've got to consider is, well, when did they buy these land and buildings in the first place? So land and buildings, we know in the first place they cost £240,000, and they were going to depreciate them over 40 years. So if I do £240,000, the original cost, divided by 40 years, that means they've been depreciating them at a rate of £6,000 per year. We know that they had depreciated them up until this point by £72,000. So if I divide £72,000 by £6,000, that tells me then that they must have owned these land and buildings for 12 years. That's how many times they've depreciated them by £6,000. If I go over to point number 1, it explains to me land and buildings were revalued, but then it says following the revaluation, they are to be depreciated over the remaining useful life. So they originally had a useful life of 40 years, and we've just worked out that they've already owned them for 12 years. So the remaining useful life then is 40, take away 12 years, there are 28 years of useful life left of these land and buildings. So I now take the new value, the new 420,000, I'm going to divide that by the remaining useful life, which is 28 years, and that tells me then that these buildings, land and buildings, now need to be depreciated at a rate of £15,000 per year. So that's going to be the charge for the year, and I can enter that now, there we go, into my statement of cash flow. Right then I'm going to move on to the plant and machinery. Let's get a box to do some workings for this one. There we go. So what do we know about the plant and machinery? If I look at the third bullet point, plant and machinery are depreciated using the straight line method at a rate of 20% per annum. I've got to remember though that they purchased some plant and machinery during this year. And because this business, their policy is to do depreciation on a month-by-month basis, I've just got to be a little bit careful here. So what I'm going to do, I'm going to start with the plant and machinery that they have owned all year along. And we know that the plant and machinery that they had at the start of the year had a cost of £80,000. They've had that all year, so I'm going to do £80,000 times 20% equals 16,000. So the plant and machinery they've had all year needs to be depreciated by 16,000. Then I'm going to look at the plant and machinery that they purchased during the year, which cost them 22,000. So 22,000, 20% of 22,000 is 4,400. But they haven't owned these ones all year. And if I go back to point 2, it tells me plant and machinery was purchased for 22,000 on the 1st of July 23. And we're going up to the 31st of March 24. So if I work out the months that they've owned it for the whole of July, August, September, October, November, December, January, February, March. So they've owned these for 9 months of this financial year. So I need to take that 4,400, which is a yearly figure, and find 9 months of it. So divide by 12 months, multiply by 9. So the depreciation that needs to be done on the ones that they bought is 3,300. So I can now add together the 16,000, which is the depreciation on the 80,000 that they've owned all year, plus the 3,300, which is the depreciation on the ones they've bought during the year, and that gives me then a total charge for the year of 19,300, and I can enter it then, here we go, as the charge for the year. Okay, then we come round to the motor vehicles and the depreciation for motor vehicles. And in this question, this is where the most workings are going to be because there's quite a lot going on here. We know that they sold a motor vehicle and we're given the dates when they sold it and when they purchased it. And we already know that this company uses monthly depreciation. If I look at that second bullet point, I'm told that motor vehicles are depreciated using the reducing balance method at a rate of 20% per annum. And the fact they use reducing balance is the reason that this becomes a little bit more tricky. If the company had used straight line depreciation, I could just work out the annual depreciation on the vehicle and then adjust it for the number of months that they owned it for, a bit like we did for the new plant and machinery they bought. Reducing balance is a bit more complicated, as I say. The reason is we're going to have to keep recalculating the net book value of the motor vehicle at the end of each financial year. So this company's financial year ends on the 31st of March. So we know that we're told that the motor vehicle was originally purchased on the 1st of October 2021. So the first time they would have depreciated it would have been the end of the next financial year, which would have been the 31st of March 2022. So I'm going to start some workings then. Here we go. So on the 31st of March 2022, the company would have worked out the net book value. So they would have taken the cost, which is £15,000, and taken away any depreciation done to date. But there wouldn't have been any because they only just bought it during that year. So the net book value would have been £15,000, the same as the cost at this point. They would have found 20%, and that would have given us a depreciation of £3,000, as you can see there. They didn't own it for all of that year. So they bought it on the 1st of October. So they owned it for October, November, December, January, February, March. They owned it for 6 months, half of that financial year. So I'm going to take the £3,000, divide it by 12 months, multiply by 6 months. So in that first year that they owned it, they would have depreciated this vehicle by £1,500. Then another year would have ticked by, and we would have come round to the 31st of March 2023, and they would have depreciated this vehicle again. So they would have started by working out the net book value, and you can see my workings there. So the cost, 15,000, but they've now got £1,500 of depreciation from the year before. So take that away. So the net book value at this point would have been £13,500. They then would have found 20% of that figure, and that would have told them a depreciation charge for the year of £2,700. I don't need to adjust that figure because they owned it for all of that financial year, all 12 months. Then we come round to the year that we're talking about now, the 31st of March 2024, and they would have worked out the depreciation again. So they would have started with the cost, 15,000, take away any depreciation that's already been done, the accumulated depreciation, and the two figures that are highlighted, the 1,500 from the first year they owned it, add the 2,700 from the second year, comes to £4,200. And you can see I've taken that away then. That's the depreciation that had been done before. So at this point, the vehicle had a net book value of £10,800. They would have found 20% of 10,800, 2,160, but they sold this vehicle, they disposed of it during this financial year, and we were told they sold it on the 31st of December 2023. Remember, their year ends on the 31st of March, so it must begin then on the 1st of April. So we just have to work out the months that they owned it. So they would have owned it for April, May, June, July, August, September, October, November, December. 9 months of this financial year. So the 2,160, I'm going to divide that by 12 months, multiply it by 9, and that tells me the charge for this year would have been £1,620. So I can add together the three figures that are now highlighted, which is the three depreciation figures that would have been done during each financial year that they owned this vehicle for. And that gives me then a total of £5,820. And so that figure, I can then, you'll see I've put it in there, that's the figure I'm removing then from the depreciation. So eliminated on disposal, £5,820. All of that depreciation needs to be removed from the books because they no longer own the vehicle. Then I come round to the charge for the year. And I need to work out, this is essentially the figure that would have appeared in the income statement, the depreciation charge for the year on the vehicles. A bit like we did with the plant and machinery, where we worked out the depreciation on the plant and machinery that they'd owned all year, and then worked out the depreciation on the new plant and machinery, I'm going to do something similar here. So I need to work out the depreciation that would have been done on the vehicle they got rid of, and then the depreciation done on the vehicles they've owned all year. Well, we've actually already worked out the depreciation on the vehicle that they got rid of. I'm just going to repeat the workings. There we go. It's the working we just did a moment ago. Because during this final financial year, the one we're talking about now, 31st of March 24, we've already worked out that the vehicle would have been depreciated by £1,620. So that would be the charge for the year on that vehicle. So it might look like, well, why are we taking it out and putting it in? But we have to put it in because it was a figure, it was depreciation, it would have gone in the income statement as an expense. But we also have to remove it, as we've already done when we've eliminated it on the disposal. This business would have entered the depreciation whilst they own the vehicle, but then we need to remove it because they no longer own the vehicle. Then I just need to work out the depreciation on the vehicles they've owned all year long. And you can just see it on my screen where we have the cost section. We know that the motor vehicles at the start, the cost was 55,000. We know that they disposed of this one that cost 15,000. So the remaining cost of the other vehicles then is £40,000. So my first working is going to be just that. So I know that the vehicles they've owned all year long, in other words, all of the vehicles apart from the one they disposed of, had a cost of 40,000. I need to work out the depreciation, and this is where it'd be easy to get caught out. We know that this company at the start of the year had £14,300 of depreciation on these motor vehicles. I've just got to remember though that in that 14,300 is some depreciation that is associated with the vehicle they disposed of. And if I look back over at my yellow highlighted figures, they depreciated the vehicle they disposed of by 1,500 in the first year and then 2,700 in the second year. Both of those figures will be included in that £14,300. The 1,620 won't be because that's only been done this year, so that wouldn't have been in the balance at the start of this year. So 1,500 plus 2,700 we know is £4,200. So in that 14,300 I need to take out 4,200 because it relates to the vehicle they got rid of. And you can see my working there. So that means there is £10,100 of depreciation in the books that must relate to the other vehicles, the ones that they've held all year. Now I can find the net book value. So 40,000, take away 10,100. The net book value of the vehicles they've held all year is 29,900. Find 20%. So that tells me then the charge for the year on the vehicles they've had all year is £5,980. And if I add together the two figures highlighted in blue, I get my total charge for the year then on vehicles, £7,600, and I'm going to enter that now as the charge for the year. There we go. Right, nearly there then. So now I can just finish off my schedule of non-current assets. You'll see I've taken the working box away so we can see it all again. So next thing to do to finish the depreciation section is to just total it off. So just like we did with the cost section, I'm going to have a figure at the end of the year. There we go, at the 31st of March 24, and I'm just totaling the depreciation section for each type of non-current asset. And then finally, I said at the start, think of a schedule of non-current assets in three sections: cost, depreciation, and then the final section is net book value. There's my heading. And then all I'm going to do is work out the net book value then at the end of the financial year. And I've done it there. So for example, the land and buildings, take the cost figure at the end of the year, which was 420,000, take away the depreciation at the end of the year, 15,000, means the net book value is 405,000. And then do the same for plant and machinery, 102,000, take away 41825, gives them a net book value of 60,175. And then likewise motor vehicles, 40,000, take away 16,080, gives them a net book value of 23,920. And then normally on a schedule of non-current assets, the final thing we do is show the net book value figure from the end of last year or the start of this year. And you can see it there. I've just copied it from the table that we were given at the start of the question. And that's just so that anybody looking at the accounts or this document just can use it as a comparison to see how the values have changed from the start of the year to the end of the year. And there we go. I hope that's been helpful. Please do remember to subscribe to the channel, like, share, comment on the videos, let me know what you're finding useful and what you'd like to see in future videos.